SD Metals and Markets is brought to you by Docs Deals. Find the best deals on gold and silver online at sdbullion.com/deals. This week's specials include intro any quantity pricing on 2016 Perth Mint Lunar Rooster gold and silver coins and fractional 10th ounce platinum eagles, available for the first time on SD Bullion. Each week's Docs Deals arrive Monday mornings at 10 a.m. Eastern. Find the best deals on gold and silver online at sdbullion.com/deals. This is the Doc and Eric Dubin with the SD Weekly Metals and Markets. Joining us today is our good friend Dave Kranzler. Dave, it's great to have you back on.
Thanks for having me back on. I love being on here with you guys. It's a great show.
Well, it's been a brutal week for the metals. Silver in particular, down almost 15% on the week. It's been hammered every single trading day of the week. It really began last Friday, and the rout continued today. We got a bit of a jump on the jobs report this morning when it came out at 8:30. But then we were hammered right back down with the algos following their same pattern, hammering the metals at around noon Eastern every single day this week. This morning, silver traded almost all the way back down to 1710 before recovering back above 1750 here in the Globex session as we record this afternoon. So let's start with the metals here, Dave, and your thoughts on the brutal hammering gold and silver have experienced here this week.
Well, I mean, it actually started last week, and to me, it just looks like a sort of a standard. The paper gold open interest on the COMEX got up to be, it actually hit an all-time high in, I think it was August or maybe late July. So it was, close to 650,000 contracts, and I don't remember the exact number. And as of yesterday's close, it was down to 511,000 contracts. So what they do is they go in, and when they decide it's time to implement a price management operation, they go in and they hunt for the sell stops that are set by the hedge fund black box programs, and they run the stops, and that's what's been going on. If you look at, we did this when we were preparing for the show, and I looked at the COMEX all week this week, and starting with every day when the COMEX opens, and then intermittently throughout the day, there'd be huge spike ups in sell volume on the COMEX, and that's the price managers dumping paper gold into the COMEX system, both on the floor and in the electronic system, and they're trying to set off the stop loss orders set by the hedge funds, and then that triggers even more selling. And the open interest just this week has come down by over 54,000 contracts. And that's over 5.4 million ounces of paper gold, which translates into 169 tons of paper gold. That's how much the open interest has come down from last Friday through yesterday's close. And there's no rational explanation for that, especially when you consider, other than the Fed official jawboning about raising versus not raising interest rates that's been going on all week, all of the material fundamental news would suggest that the price of gold should be going up. And of course, this is just another form of financial terrorism and another form of financial propaganda, where when you would think that the price of gold should be going crazy to the upside, they decide to manage the price with paper gold. And it just so happens that China was shut down all week and I'm not even sure what holiday it was, but there was a week-long holiday observance. So the Shanghai Gold Exchange was closed. Obviously, the import avenues would have been closed down. I mean, basically, business is shut for the week. And so this was kind of an ideal week for them for the price managers to come in and really slam the price of gold. But to me, the overriding question here is why all of a sudden now, after gold ran up the way it's run up since mid-December, why have they decided that now they need to, manage the price of gold and take it lower? And to me, it kind of smacks of 2008, because they did the same exact thing right as Bear Stearns was blowing up, and then they did the same exact thing in the summer of 2008, right before Lehman collapsed. So to me, I think it's not coincidental that there's all this news swirl around Deutsche Bank, and there's no question that Deutsche Bank's in a lot of trouble. And I think that there's potentially some sort of uncontrollable financial event looming on the horizon, and I think they're trying to get the price of gold down as much as possible ahead of that. Because if the news were to leak out and it was believable news that there's a financial systemic problem coming, you could start bank runs here and in Europe. And quite frankly, I think anyone who leaves their money, any significant amount of money beyond how much they have to pay for use for paying bills on a weekly or monthly basis, anyone who leaves any more money than that in the bank right now is an idiot. So that's my take on why this week, why they're being so aggressive. And, obviously only our corner of the world really cares about this, but it's just, this is about as blatant of manipulation as I've seen in 15 years.
Yeah, I agree 100% with everything Dave just said. And I think we can put it into the context of the last couple of weeks with what's going on in the European banking system in particular, and with what was going on with Deutsche Bank last Friday. We had that rumor come in about how the Justice Department was going to give Deutsche Bank a reprieve and not demand $14 billion plus in fines for the mortgage bank fraud stuff that Deutsche Bank was partaking in. And that saved the markets. It saved Deutsche Bank. Deutsche Bank shot up a lot, and it turned out that was just somebody injecting a rumor to precisely do just that: save the market, save Deutsche Bank, buy some time. We have something similar today going on with Qatar being rumored to be making a $1.2 billion investment into Deutsche Bank, and Deutsche Bank desperately needs new capital. They are insolvent, as Dave has rightfully documented really well in a lot of great articles. And so we have all of that as backdrop going on. We have the technical picture, actually, as we were talking with Craig Hemke last week, in terms of higher lows being established in both gold and silver leading up to last Friday. The markets were beginning to repair themselves, and with China being out this week, and with everything that's going on in the European banking system, and the fact that it's teetering. I mean, last Friday we saw some pretty significant moves, and Thursday prior as well in Deutsche Bank, as it was just moving around with high volatility. As we saw pricing in of that issue where some of the hedge funds that are involved with Deutsche Bank were, a little spooked, and they were advising to, close out positions because they were worried about Deutsche Bank as a counterparty. So we know also, reported in the news that there's been a lot of discussions going on at a high level between the, Treasury Department officials and German officials, and they're trying to put out the fires that are going on in the European banking system as we record right now. It's been going on for weeks. It's getting even more intense. And the volatility that we're seeing is reflecting this. We saw yesterday a huge move of over 6% down in the British pound sterling versus the dollar, and they're blaming that on largely just a market reaction based on interpretation of Theresa May being more anti-business and not being, friendly to the City of London banking interests when it comes to the negotiations of what will happen with Brexit. But this stuff has been in the market for weeks, so I don't buy that excuse. I think that probably we got some the volatility, in the very least, that we're seeing expressed in the currency markets is reflecting the intense instability in the financial markets overall. In the very least, that's just a baseline condition that was necessary to create the kind of instability that, even if it was a fat finger triggering yesterday's move in the pound, it's prima facie evidence that that's what's going on. We have very unstable financial markets, and everything's just going crazy. The volatility in the currency markets in particular, and Eric Sprott makes this point all the time, it's just off the charts. It's crazy. And we are getting to the point where all these plates that the powers that be are trying to spin and juggle will eventually start crashing, and that's going to happen. And that's why they're going after gold now. I totally agree with Dave's assessment. The unemployment report is interesting too, because like what we were talking about, Doc, last week with Craig Hamke. It did come in the middle of the road kind of number, not too hot, not too cold, just enough to dial back the week-long fiesta we've seen with the jawboning expectations of Federal Reserve board members and FOMC voters coming out and talking up the dollar, and now the dollar's being taken down.
Yeah, and it's certainly been amazing to see this week the response on the physical side with silver prices taken down nearly 15% in 5 trading days, gold trading actually below $12.50 here this morning on Friday. The physical demand has been astonishing. We've been talking for several months that on the wholesale side, there's actually a little bit of an inventory surplus or glut that had developed really over the first 6 months of the year as the APs stockpiled and accumulated all the ounces of silver as they could to make sure they had enough coins for the next shortage. And then that really never materialized, so they were left with a pretty massive inventory of coins, and that's been reflected in the poor sales numbers over the last 3 months at the U.S. Mint. But that reversed with a vengeance this week. The U.S. Mint is reporting they've sold 1.355 million coins this week, which that alone is higher than the entire numbers of August and almost higher as July and September as well. But we were discussing a little bit before the show that I'm not exactly sure if the U.S. Mint counts their sales totals by deliveries or by orders. Now, I'm pretty sure it's by orders, because if you watch the numbers on weeks, I guess back up, if you watch the numbers during periods of allocation, when their output is 1 million coins every single week, on the weeks that there are federal holidays, they were only posting 800,000 coins that week, which made sense because their production was about 200,000 coins a day. So from everything that we see, looking at the U.S. Mint sales numbers closely and scrutinizing them almost daily for the past several years, without official confirmation, it certainly always appears that those numbers are orders they've received from the APs. Now, I say that 1.3 million number is a bit suspect here, is that over the past 24 hours, we've had conversations at SD Bullion with just 2 of the top 10 APs. One of them is probably in the top 2, and one of them is probably in the bottom 7 to 10. And their CEOs and head of their trading desks have each told us that they have, just those 2 APs have ordered right around 1 million or 1.1 million coins. So in order for those Mint numbers to be accurately reported, you're looking at 200,000 coins for the other 8 APs combined, and I just don't see that as being very, very plausible whatsoever. So it'll be interesting to see what the Mint reports as sales numbers next week. But I can tell you at SD Bullion, the sales have been off the charts. Both Tuesday and yesterday and Thursday were all-time record sales days. Tuesday, we sold basically 5% of all of September's sales in one day on Tuesday. We sold, I think we went through close to $2.5 million worth of bullion, took just under 600 orders. So, the phones are ringing off the hook. There's new investors. The demand for physical has been quite astonishing. As far as the premium side, 90% has moved up about 40 or 50 cents in the wholesale market. Silver maples have started to move. One of the largest APs completely sold out of not only all the silver eagles that they had inventoried, they had also sold out of all the silver eagles they ordered for next week, which is pretty amazing from the state of where the market's been the last couple of months. Most of the private mints are about a week and a half out on private silver products, and they're saying all silver products, silver rounds, silver bars, 100-ounce bars, you name it. They're at least a month and a half out. The Sunshine Mint, they're famous rounds, the Walking Liberty round. It's our SD Bullion's #1 best-selling silver round. They went from live and in stock to a month delay, pretty much in 24 hours on Tuesday to Wednesday. And it's not even just silver. Pretty much all of the most popular gold bullion products, whether it be generic gold bars, 1-ounce bars, or current year gold eagles, maples, buffaloes, they're all the APs, or I should say most of them, are sold out of inventories and are waiting to get resupplied next week. Now, it doesn't mean...
Hey, Doc, when I hear you take off all of the various things that you're noting, the change in the Sunshine Mint inventory sounds like it's the most significant in terms of what we might glean from that. Is that also your opinion?
Yeah, I mean, we've talked to Tom Power of Sunshine quite a bit. Their numbers, I mean, they supply the blanks to the U.S. Mint. They crank out a massive amount of bullion. So, yeah, I mean, you're talking about a significant amount of silver. And along with that, I'm not sure if our listeners are aware, A-Mark just acquired Silvertown, and they released a little bit of their numbers publicly. Gives us a perspective of the market. Silvertown last year in 2015 produced 12 million ounces of silver rounds, and A-Mark's looking to up their output to 20 million ounces a year here this year. So that you can kind of extrapolate that a little bit across the market. So it's pretty interesting intel, and it's kind of like what we've been saying all along. People, I think, vastly underestimate the amount of silver rounds and silver bars that are being taken down by the market on the private mint side.
And how fast the market changes, too. So when it comes to the percentage of the premium for 90% generic silver, what is that at now? Over spot price percentage?
The retail market has jumped up to, I think we had to raise our prices to somewhere around, off the top of my head, I think it was 160 or 170 over spot. Most of the retail dealers are close to $2 over spot right now. We'd been, at SD Bullion, we'd been selling 90% at $1.29 for, I don't know, a month or two. And the rest of the market had been selling at about $1.50, $1.60. So, I mean, it's still nothing like we saw a year ago when 90% on the wholesale market was $5 over spot, but it's definitely confirmation of that inflection point and trend change, and premiums are moving the other direction.
Yeah, well, since we're talking physical, Dave, you had a lot of interesting comments before we started the show about what's going on with India. The fact that China's been out of all week, and that India has been taking down gold noticeably, as we can see the footprints in terms of the prices and whatnot. I think our listeners would really appreciate hearing that. So let's talk about India. What are you seeing?
Sure. I mean, clearly there's been a huge spike up in demand for physical silver. I'm sure the same is true for gold in the retail market here. And now India's back in play from a legal import standpoint. So for the last few months, I don't know, it may even go back to really, again, this is just from rote memory, but, probably June, maybe even May, the price of gold has been high enough on the global market so that, it was high, it was low enough in India on a relative basis so that they were not importing gold because the price that Indians were willing to pay over there after you take into account the 10% import duty on kilo bars, it essentially was what was called a negative premium. And in the last couple of weeks, I've been watching, and I get the numbers on a daily basis from John Brimlow, and the numbers have been, for the last couple of weeks, have been headed towards positive territory, and this week they were positive earlier in the week and then extremely positive last night. So what that means is that in addition to all the gold that's being smuggled into India, and in addition to the doré bars that are being imported because the import duty is lower, so an 80% refined doré bar that comes directly from mines, it doesn't take as high a price as the kilo bars, the fully refined kilo bars, in order for doré bars to be imported. So in addition to those two sources of imported gold or gold going into India, now all of a sudden the kilo bars are back in play. and this is just ahead of their Diwali holiday, which is, I think it might be their biggest gold buying holiday, and that all the buying will go ahead of that. So India now, this price takedown in the paper market over here has woken up Indian buyers, and that's typically what their pattern is. They won't chase prices the way that we'll see sometimes happen over here, especially in the paper market. They won't chase prices higher. They wait until the manipulators hit the price of gold, and then all of a sudden they're buying hand over fist, and that's what's happening now. But it's also Asia in general. Now, even though China's closed, there was a Reuters report out last night, and the headline was Asia gold demand rises on price drop. And that's the same. It's the same dynamic in Asia that it is with India. They're not necessarily prone to chasing the price of gold higher, but whenever it gets hit, all of a sudden, especially at the retail level, demand picks up considerably. And there was a dealer out of Shanghai.
Let's explain to Dave. Dave, can I pause or interrupt for just a second? Explain to the listeners why that is, why India doesn't chase price higher typically, and they respond to the dips. The way that I see it to explain is basically it's a completely different philosophy. The Western markets chase price higher because everyone's speculating on it as a financial asset. They're trying to chase the momentum and make money on the momentum play. They're just purely looking at it as a financial asset that they're chasing momentum. Versus the Indian buyers, they're looking at it as a purchase for jewelry, and it's really no different than a commodity like, say, milk, eggs, or gasoline here in the U.S. If gasoline spikes to $5 on whether it's fundamental reasons, whether it's a short squeeze, speculators, whatever, demand goes down. All the consumers don't rush out to buy gasoline. They don't. If the price of milk is soaring due to inflation, it's going to decrease the demand. So that's why in India you see a more normal economic response. By normal meaning like the type of response you read in a textbook, because the
Indian buyers are buying for store value purposes more so than any other reason. Whereas in the West, we got paper markets that dominate price discovery, and those guys are mostly just, momentum chasers. It's a financial asset, like you're saying.
I'd maybe compare the dynamic to what we call the stackers over here, right?
Yeah, exactly.
The stackers start loading up when the price gets hit, and there's probably a lot of stackers buying this week, but they stop buying when the price bounces.
The stackers are store value insurance buyers, basically, from a philosophical point of view. And they're the minority in the market. The paper boys are dominating everything.
Right, and that's kind of what the dynamic is in India. I mean, in addition to, they buy it for jewelry, but it's also, if your daughter's getting married, you got to send her to the altar with a ton of gold.
Yeah. You're a lucky man.
Tradition, and it's
yeah. Right.
It's also a store of value over there, and it's the same kind of dynamic over in Asia. So
it's almost how your grandmother shops at the grocery store. She's going to buy a dozen eggs every single week, no matter what, as long as she can afford it. But if she sees a 2-for-1 sale, she'll buy two.
Right. In this Reuters article I mentioned, there's a quote in there from a Singapore-based gold dealer, and he basically said individuals as well as businesses were picking up physical gold as they see this pullback as an opportunity. That's the same thing what the stackers do over here. And I actually kind of equated it, Doc, to something you had mentioned. Remember when the premiums had gotten really high on silver, and then all of a sudden the premiums came in a lot, and you had made the point, now is when you want to buy silver when the premiums are low, but the tendency for the retail market over here is to chase the premiums higher. And I kind of was explaining what's going on in India and Asia, and those, it's similar to what you had talked about there. You don't want to buy silver when the premium is at $6 an ounce. You want to buy it when it's at $2 an ounce.
Right, exactly. And honestly, it's the same thing whether you're a retail investor, whether you're a retail bullion dealer, or whether you're an AP wholesaler.
have the same tendencies that everybody's emotion gets in the way, and you see the premiums rising, and you want to get in front of that. You want to stop. If you see the premium rising 50 cents a week, you increase your purchases because you want to get ahead of that expected extra 50 cents you're going to be paying next week. It's kind of a self or positive feedback loop, if you will.
I can't emphasize enough that this is just another one of many paper manipulation operations that we've seen over the last 15 years, probably even longer. I mean, I've been doing this sector since '01, so and I equate it to financial terrorism. It's a shock and awe. They want the press to be all over the fact that gold is no longer a safe haven. It's no longer a store of value. Look, it's down 10% in the last 2 weeks. And so they want the negative media propaganda to come out on it, and they want to scare people away. But why? First of all, why would they care whether or not Americans want to waste their money buying gold and silver, right? And so why would they want to scare people away from buying it? And to me, it's just another one of their methodologies that they use to cover up bad news that's occurring or bad news that's coming. And so the obvious conclusion there is right now is that you should be buying. And in fact, I've been moving money into BitGold every day this week. I did twice yesterday, and once we get off the phone, I'll probably move some more money into BitGold. And it's the first time in a few months that I've actually moved money out of my checking account and converted it into BitGold gold.
Well, the election is on the horizon, and the Fed expectations now are 64.3% probability for the futures markets for December 14th hike, and the whole cycle now repeats. The whole notion of even even the notion of a November hike. They were literally before the jobs number this morning. Futures markets were pegging probability at 23.6%. Now, post-job report, 17.1% for November FOMC, hike. And
well, it got as high as like 85% for a September hike, and that came and went with nothing. They're not hiking rates; they can't.
Yeah, it's pretty crazy. I mean, they might actually do something similar to December 16th last year, where they did the token so-called 25 basis point Fed funds hike. It wasn't even a full, but I think it was like a net impact of like 13 basis points or something within the first week.
Yeah.
They need to do something when it comes to what's going on with the compression of bank earnings with negative interest rates in Europe, and then the dollar crisis where there's not enough available collateral within the system, and at times that creates problems within the derivatives market that they're terrified of as well. So I always describe this as the policymakers trying to juggle plates, and the spinning plates of being just untenable, and at some point they're going to have accidents. I think yesterday's pound sterling display of fireworks is an example of that kind of instability expressing itself. So it's going to be a long slog. We have a lot of repair to get through when it comes to the amount of damage that was inflicted this week. But I don't think the fundamentals have changed one iota. The fundamentals are actually stronger, and we're once again just facing a masquerading of what are in fact the real market conditions by the paper impact of bombings on COMEX this week. That's the prime, the manipulation that's been going on, as well as a little bit of an assist in London for the earlier portion of this week. We've been here before, and it's frustrating, and a lot of our audience members, particularly people who are new to these markets, are probably going to think, they'll buy into that whole notion of the powers that be will always be able to control these markets and never, ever fail. And that's not true. The degree of volatility that we're seeing since the catching of the markets from the 2008 crash is getting worse. It's accelerating. The volatility we see in the currency markets, in the bond swings, and so forth. I mean, the pound sterling is the fourth largest trading or third largest trading currency in the world, and fourth largest. And for a 6% or 6.1% move yesterday, to happen in this kind of a market is very telling. You know, the news coverage on the event is basically the entire financial press scratching their head and not knowing what the heck happened and openly trying to make up stuff to explain it. That's how unstable the financial system is right now. It's quite scary.
And speaking of volatility, certainly expect we'll see quite a bit of volatility on Sunday night as China reopens after the week-long holiday to find gold down nearly $100 and silver down $3.
Yeah, I think we'll go up next week. And it's just a question of how fast we repair the market damage, and it probably will take a little bit more time than average because we saw the cartel able to just destroy sentiment on a short-term basis. But, you know, ETF buying was on a net basis this week actually positive in GLD. I mean, who knows what the heck's going on under the hood with GLD in terms of the validity or the confidence we can have in the statistics they report, but that's interesting. I mean, it does look like there's some buying of the dips going on and recognition of the fact that the fundamentals really haven't changed, and this was just all a paper masquerading of whether, in fact, are really the true fundamentals for precious metals.
All right. Should be an interesting week next week for sure. Dave, it's always great to have you back on the show.
Thanks for having me on. I'll do it anytime you guys want to. I love rapping with you guys.
And so just tell our listeners who are unfamiliar with the work that you're doing with the Short Sellers Journal and the mining stock newsletter that you produce, Dave. Tell us a little bit about that.
Sure. Real quickly, my website's investmentresearchdynamics.com, and I try and hopefully provide some informative posts. I try to get one out every day, sometimes multiple a day, depending on my state of agitation. And then I have 2 subscription journals. One is the Short Sellers Journal, and that's a weekly newsletter, and they're both delivered via email. And that one, usually what I'll do is I'll give a summary of my take on the market, what's going on and why, and then I typically will try and review some of my older short ideas and then try to present a new short idea. And then the Mining Stock Journal is bi-weekly, so it's twice a month. And in that one, I try to do an extensive analysis of what's going on in the precious metals market and with the mining stocks. And then I'll typically try to present a junior exploration idea and one that's not well covered by Bay Street or Wall Street or by other newsletter writers. And it's typically going to be companies that are exploring promising properties. And then I'll also roll out a summary issue where I'll review some of my previous picks and update those and what my thoughts are on them at this point. And the last issue, and probably this issue that's out this Thursday, I'll do that. Plus I'll talk about, there's also some of the large caps have become incredibly cheap, First Majestic being one of them. So, I'll throw out a couple of what I'd like to term sort of swing trade ideas where I think you can take advantage on a lower risk basis and get good returns by jumping into a couple of large cap ideas and either buying the stocks outright or buying some call options on them or something like that. So, that's what I do. And then the analysis that I provide in both my journals is going to be a lot more in-depth and extensive than what I post on my blog.
And the amount of carnage that has come in the correction for the sector, I mean, people are well aware of the 20 and change down to 17 that silver has transversed, but the miners, just as an example, I mean, we've seen almost a 75% from peak to bottoming this week in JNUG. 75% reduction. I mean, the kind of carnage that's in the mining shares, pretty profound, and this is a great buying opportunity. Anyone who believes the precious metal is going up in price over the longer term is going to reap significant leverage in miners right now.
Yes, I completely agree with that.
All right. So, Dave, again, it's great to have you back on the show. Hope you have you back on soon in a week when the metals have been ripping to the upside instead of another week of incessant hammering.
That sounds good to me. I don't mind coming on whenever you want me to come on.
For the Doc, Eric Dubin, and Dave Kranzler, thanks for tuning in to this week's SD Weekly Metals and Markets.